How's it going, everybody? Matt Diamond with Kalshi, and today we're talking strategy. I've done a video about how to trade bull flags. Today we're going to do the opposite. How to trade bear flags on the S&P 500 and the NASDAQ 100 daily brackets. And now let's talk about what a bear flag pattern is. It's a bearish chart pattern that's formed by two declines separated by a brief consolidation or retracement period. The flagpole forms on an almost vertical panic price drop as bulls get blindsided from the sellers, then a bounce that has parallel upper and lower trend lines, which form the flag. So to keep it very simple, you have an aggressive move lower, and then there's some sort of short-lived bounce or a sideways consolidation, which is essentially the flag. And then once it breaks out of that flag, we're expecting more continuation to the downside. Now to go into the S&P 500 daily chart, which is what you see in front of you. Now we have been trending up. This has been a strong market this year. So typically bear flags are going to work best in weak markets. So they may not have as big moves down in a trending market that's going to the upside, but I'll show some good examples and just show the theory of what it is. So the very first example that I see looking at the far left after a very large move down. So first you have the accelerated move to the downside, and then there is some sort of bounce. Aggressive move to the downside. It could not bounce very strong. So you had bulls that are trying to get in, expecting a move to the upside, and then it goes back and forth. Here's the pole, and then this forms the flag, and then what do you know? It breaks out of that flag pattern and has more continuation to the downside. Now to go on the back end of Kalshi and structure that trade, the S&P 500 daily bracket ranges. The breakdown of that bear flag happened right around 3,700. So that's going to be the range that we want to trade at. We don't want to go too far below. We're going to keep it right at that level where it breaks. These numbers are going to be off because this is the more updated price action, what's going on right now, but we'll still use it as a good example. So if we're going to trade that bear flag, and we know that the breakdown of the bear flag, when it broke out of it, expecting more continuation to the downside, what we would want to do is at that range, 3,700, maybe even just slightly below, but not too far below, we would want to trade the yes shares to the downside, because if it does have that continued bearish momentum, there's the likelihood that it's going to close in those lower ranges. So now let's go over another example of a bear flag. It's not easy to see because the market has been trending higher, but here's the concept. Pretty aggressive move to the downside right here once it broke some support. And then we had the bounce. So we had the pull, and then we have the bounce forming the flag. Could not move higher, eventually broke down out of that flag right around this 4,000 level. And then you had continuation to the downside. And now to structure the trade on the back end of Kalshi, going into the S&P 500 daily bracket. And remember that level that I said where that bear flag had continuation to the downside, 4,000. So that would be the range where you want to focus on, maybe just a little bit below, but not too far below. And you want to trade the yes contracts in those lower ranges, because if it does have that continuation, there's the likely probability that it's going to close in those ranges. And now let's do one more example of a bear flag, a recent one. Look at this pretty aggressive move lower. So there is the pull that's formed. And then we had a short-lived bounce, or the flag, right around that 4,500 level. So strong move lower. And then you had the bounce, the short-term consolidation, forming that flag pattern. It breaks below the flag. And then we have continuation of the trend to the downside and a bear flag pattern that happened to work out well. And now to structure the trade on the back end of Kalshi, S&P 500 daily bracket. The level that I mentioned was 4,500. So we would want to go to the ranges that are right at it, maybe just slightly below. So 4,475 to 4,500, maybe even one below, 4,450 to 4,475. We don't want to go too far below. And then what we would do is trade the yes shares on these lower ranges, because if that bear flag is successful and we get that momentum to the downside, there is the likely probability that it closes in those lower ranges. So that was the S&P 500 daily chart. Now let's look at some bear flags on the NASDAQ 100. So here's an example that I see. You have a pretty aggressive move to the downside, looking at the far left side of this chart. And then you have the short-term bounce, or the formation of the flag pattern. So we have the pull and we have the flag. And then it breaks out of that flag right around 11,600. And then we get more continuation to the downside. So a successful bear flag pattern. And now to structure the trade on the back end of Kalshi, going into the NASDAQ 100 daily brackets. These are going to be slightly off because that bear flag happened a long time ago. But the level that I mentioned, right where it kind of broke down at, was 11,600, 11,500. And we would want to focus on that range, maybe even one just slightly below. And then we would want to trade the yes shares to the downside, because if it does have that move lower out of the bear flag, and then we have that bearish continuation to the downside, there is the likely probability that it's going to close in those lower ranges. And here's another example of a bear flag. And I think this is going to be a good example because it shows that the concept of these patterns is to have some sort of aggressive move to the downside, a short pause of consolidation and continuation. So they're all going to look slightly different, but the theory is the same. Here's where I see another pretty quick bear flag pattern that happened on the daily chart. So we got an aggressive move lower, broke some support, had a nice move to the downside, and then here's the very quick formation of the flag. So we have the pull, and then we have a short-lived bounce forming that flag pattern. It breaks out of that flag just above that 11,000 level. And then once it broke below this flag pattern, we had some continuation to the downside. So now to structure the trade on the back end of Kalshi, going into the NASDAQ 100 daily bracket, and that level or the area where it broke down out of that bear flag was right around 11,000. So we're going to want to focus on the ranges that are at 11,000, maybe just slightly below. We don't want to go too far below. And then we're going to trade the yes shares in those lower ranges, because if it does have that downside continuation, there's the likely probability that it closes in those lower ranges. And now let's do one last example of a bear flag, one that happened more recent. So looking at the far right, the top right, we had a nice move to the downside on the NQ. There's the pull, and then we had a very short-lived bounce forming the flag. So aggressive move to the downside, short consolidation, and then ends up breaking down right around that 15,000 level. And we get more momentum to the downside for a successful bear flag pattern and more price action to the downside. And now to structure the trade on the back end of Kalshi. So here's the bear flag pattern. The top right broke down right at that 15,000 level. So we're going to want to look at 14,900 to 15,000, and even the one just below that if this was up to date. And we would want to trade the yes shares on those lower ranges, because if that bear flag is successful and it has that continuation to the downside, there is the likely probability that it closes in those lower ranges. So those are some good examples on how to trade the bear flag pattern on the S&P 500 and the NASDAQ 100 using the daily bracket event contracts on Kalshi. So that's it for the video. I appreciate you watching. Feel free to like, comment, and subscribe, and I'll see you in the next one.